CPI headline and core. We could talk about the Bitcoin ETF and what, if anything, that means. We could talk about consumer spending. We could talk about December home sales for Sacramento and so much more. Folks, let's get into the CPI reading. Again, we got the reading this morning. We got headline, we got core, we got month on month, we got year on year. We will go over the numbers, we will go over expectations, and of course, share what they were last time. So let's get into CPI headline. It is the most common quoted in the media. It is what you will see all over the headlines, and it came in hot. Expect a lot of folks to talk about CPI headline. It came in at 3.4% year on year. Last month was 3.1, and expectations were 3.2. So again, inflation headline came in hot. If you look under the covers, there is a lot of indication that goods inflation continues to roll over and many categories are in deflation. But yes, the slow grind to sub 3% still has work to be done. We did warn that this base effect that we have highlighted a couple of times was very small. We weren't getting any headwinds or help from that, or tailwinds, I should say. So we will see what happens next month as the tailwinds of a large base effect will be helpful. So what does this mean? I think it is fair to say that we need to stop pricing in a March rate cut. I think that is the biggest news of the day. I do not think this impacts the Fed decision on the 31st. Again, I expect that to be a pause. I do believe the next move by the Fed will be down, but that will be after a series of pauses in January and March, and I believe the next meeting is May. So again, that was all headline. Let's do core. Core did break 4%. It has been above 4% for quite a while. Last was 4% even. This month came in at 3.9. Expectations, however, were for 3.8. So again, expectations, they came in hot, right? 3.9 on an expectation of 3.8. So at the end of the day, inflation is still a problem. These numbers will further validate that the Fed will be on hold. I do expect the market to quote unquote reprice a March rate cut. I can't imagine you have inflation going up and you see a Fed rate cut. On that end, on Thursdays, we also get the weekly unemployment claims. For those hoping for a March rate cut, you really have to almost wish for, and it's kind of sad but true, you almost have to wish for weekly unemployment claims to break higher. Weekly unemployment claims came in at 202,000. They were expected to be 210,000. They were last 202. So we are bouncing along the bottom. We have seen some high-profile layoffs. I think BlackRock announced yesterday they were laying off 3%. I think you saw Amazon announce a small layoff. So you are certainly seeing some trimming, but the wave thus far, it could change tomorrow, but the wave thus far of Q1 layoffs has been a trickle. But again, more on that to come. A couple of things that I think are interesting that we should talk about here is consumer spending. Not only did we get inflation readings, but we also got consumer spending. Consumer spending for December was down from a ripping November. November was up 0.8% month on month. It was halved. In December, it came in at 0.4. Consumer spending year on year was up 3.1%. Always remember, folks, these numbers are not inflation adjusted. So let's do some math together. We just got a CPI reading of 3.4. We got a consumer spending of 3.1. So if you put those two together, now it's not quite apples to apples, but you'll get what we're looking at. You actually have on a real adjusted return, negative consumer spending. Why is that? Inflation greater than the growth in consumer spending. It is that simple. Again, 3.1% for consumer spending. Core which stripped percent. So again, December still going, credit cards going up that, going very well. We did see some deflation in consumer spending. The three largest categories are all housing related, probably not a surprise. Appliances, down 3.2%. Building and gardening, down 1.5%. And furniture, down almost a full tenth of a percent, or a full percent at 0.9%. So we are seeing some true deflation and contraction in the goods market. I think that is very important. I don't think it is discussed enough. When you look at the U.S. economy, depending on how you slice and dice it, we are about 70 to 80% services and 20% production or goods. So when you see readings like the economic indicators, the leading economic indicators, and they happen to be very goods oriented because they were created in a different era, it is easy to see why things are missed, right? The leading economic indicators have talked about some pretty negative numbers for 20 months in a row. Unfortunately, those numbers, as I think we discussed yesterday, are skewed because they are very goods oriented. So in the U.S. economy, we need to be watching the services aspect. We have seen deflation, and again, according to the consumer spending in goods prices, if you annualize it for 6 months. According to the consumer spending report, deflation, not inflation, not disinflation, but true stuff is getting cheaper in the goods arena, was down 3.7%, so negative 3.7% if you annualize June through November. I expect these numbers to continue to roll forward. A couple other things we should talk about. The Bitcoin ETF, after some false starts with some hacked Twitter accounts, has now been approved or released. I do believe there are 11 Bitcoin ETFs, if I read the article correctly, that will have or will begin trading very soon. I do think it kind of legitimizes Bitcoin as an asset class. I do think it will have a meaningful impact as more quote-unquote wealthy folks allocate a percent or two to the Bitcoin ETF. It's a way to, as I have back in 2018, created that insurance policy that just in case, where I moved 1% of my net worth to crypto. I see others doing that via ETFs. Let's talk about December home sales. Folks, we're going to start to see December home sales data roll through. I want to give a shout out to Ryan Lundquist. Ryan Lundquist is somebody I follow on X or Twitter. I think he goes by the handle Sac Appraiser. He gave us the Sacramento, California housing report. Just so you know, we're going to compare 2023 and 2022. In 2022, home prices in Sacramento were median home price in Sacramento was $530,000. Now in 2023, it is $570,000. That is a $40,000 move year on year. What about transactions? You know, I have been talking transaction crash while others have been talking price crash. We know how that call turned out. It went up $40,000. Transactions was 1,302. In December of 22, it was 1,149 in December of 23. So down about 153 transactions, so more than 10%. Months of supply last December were 1.9 months. This December, 1.59 months. So again, down about 15 to 18%. Days on market, if you choose to look that way, last year were 48 days, now 41 days. All of this to say, folks, that with falling interest rates, we will see hopefully transactions rise, but we need inventory. Again, one of the things that we should be doing is tracking active listings in our market, in our buy box. Folks, if you follow this channel, you have a buy box. You should be tracking how many things are in it, how many new, how many changing, how many pending. Some of you have told me it's getting crazy again. Some of you have told me inventory is coming. Again, when I talk national numbers, It's fun, it's entertaining, I enjoy it, but please know that this is all about you and your buy box. Let's talk about the Fed rate cut. Again, I believe there is going to be a Fed rate cut this year, May or June. But I did want to give a shout out to the first person that I have found in the media talking about no Fed rate cut. Her name is Tracy, Schuchart. She is talking about the inflation pressures are rebuilding. She is talking about geo-conflict in the Red Sea, shipping delays upwards of 2.5 weeks and additional costs. She is indicating that the Fed will not cut in 2024. That is not currently a very well-held opinion, at least if you look at the masses, but I do think it bears review. If we head into a 1970s era like Jamie Dimon indicates, we will see higher inflation, we will see low growth, and if that's the case, Tracy might be correct. Again, a lot of people are saying the Fed calls 3, the market calls 6. I think it was UBS called 9 rate cuts. So now we have Tracy on the other side talking about big fat 0 rate cuts. So again, yes, apparently it's Schuchart. Thank you for the more. And then lastly, I do want to call attention to a video that Anna Kelly and I had yesterday. Anna Kelly, if you watched the video, said, Michael, I'm seeing more and more of these videos talking about home prices and median incomes. She talked about a report I believe she saw with George Gammon. George Gammon, if you follow him on Twitter, of course, is taking the pretty charts from you-know-who. We had a conversation. Hopefully you know my opinion on all of that. Again, it is not price and income. If that is all that mattered, you can look at the data yourself. 1981 would have been a great year to buy a home. That is simply not the case. It is not how our housing market works. There is this little thing called debt or interest rates. So again, if you used price and income, you would have missed 2021 and 2022. Lots of folks missed 2021, which was the best year ever to buy a home in 50 years, and 2022, which was the third best year ever to buy a home, because you were looking at the wrong charts and you were following somebody who owns nothing. I think it is really weird that folks follow housing experts or stock experts and all of these folks when they don't actually have any skin in the game. It's just weird. It's just weird, and you can get very odd opinions. So again, I do think George Gammon is onto something, because if you've heard him, which I watch, he has talked about housing crashing. He has a caveat though, but in real terms. If you go to the 53-year spreadsheet, which all of you have access to because I give it to you for free, and you look at home price appreciation for the 70s, in nominal terms, they went up like 110%. But if you do it on a real inflation adjusted, it only went up something like 40%. So again, inflation needs to be considered. That's the difference between nominal and real. But never forget, the United States, we are spoiled. We are spoiled. We have this thing called 30-year mortgages. In fact, a 30-year mortgage is one-sided bet. What do I mean by that? Well, if you get into a mortgage and you can afford it, you're approved, you're going along, and rates go up, you don't care. If rates go down, and they go down meaningfully, you can refinance and lower your payment. Again, the bank takes, or the lender takes all of the risk. So folks, that is what's going on. That is your daily financial news. Please like, subscribe, and comment. Thank you for being here. I appreciate all the support. Don't forget to check out the other channels, the Daily Financial News and Best of ORAT.